Good afternoon, everyone. Hello, hello. Nice to see some friendly faces. Nice to see familiar faces. A warm welcome and welcome to the Ready for Life Festival. And we're just waiting for a couple more of our friends to join us. I'm Charmaine E. and so delighted to be joining you for what is today's panel. Building a strong foundation to achieve your retirement goals. So whether you are beginning to set your retirement goals or you're well into the journey, today is going to be an insightful one. We are going to be talking about actionable insights so you can unlock the full potential of your CPF, break down the essentials of investing as well. That's what we're going to be doing today, because by making informed decisions about your CPF savings and investments, you can achieve your retirement goals faster. So if you have any questions today, I told you the theme of today is not be shy. We're going to be flashing a QR code on the screens in just a few moments. Ask your questions via Mentimeter. Please do scan those QR codes either to the left or to the right of your screens, because later on we will be taking questions. So scan the code and enter the code on Mentimeter. There will be a Q&A segment later on today. Without further ado, I am very, very excited to have my panel with me. I'm just making way for that. Ladies and gentlemen, with a warm round of applause, could you please join me in inviting Woei Jiin, Director, Retirement Savings, CPF Board. Ladies first. Woei Jiin, good afternoon. Thank you so much for joining us. We also have David Ang, CPF Volunteer and Managing Director, Bank of Singapore. Hello, David. Good to see you. And last but certainly not the least, founder, Steady Compounding, Thomas, please. Right, good afternoon, everybody. I'm excited to be talking about achieving our retirement goals. We all want to retire happy and healthy, don't we? So I think let's get the ball rolling. Perhaps we can introduce ourselves. Let our audience know what we do. Woei Jiin, ladies first, if I could start with you.
Hi, good afternoon, everyone. Thank you for spending your afternoon with us today. I'm Woei Jiin from CPF Board, Retirement Savings Department. So me and the team, we help Singaporeans like yourself accumulate more in your CPF through schemes like topping up, home monetization schemes, and we also offer you services to help you plan your CPF so that you can optimize your CPF decisions.
David?
Hi, good afternoon, everyone. I'm David Young from Bank of Singapore, married with 2 kids. I must say that I've been in the banking industry for the last 30 years, where almost 20 years are spent in private banking. So my team of relationship manager and myself are providing wealth planning solutions for our client. Over to you.
Hi everyone, my name is Thomas. A big thank you to all of you for coming here today, and definitely to the organizers for putting this event together. And of course, my esteemed panelists, Jiin and also David, and also for Charmaine for hosting. I'm the founder of Steady Compounding. That's where I invest and write about investing, and my readers span from investment funds to retail investors. And the reason behind the name Steady Compounding, because I always believe in the power of consistent and long-term growth, much like how we should prepare for our retirement.
So let's get right into it, right? I think when it comes to retirement, what's important is what kind of retirement lifestyle do we envision? And I'm curious to know, my dearest panel here, what does retirement look like to you, and how did you arrive at this vision? Thomas, maybe you may like to start us off?
Yeah, so I think I have a few slides. Perhaps they could pull it up. Yeah, so I think for a lot of us, when we think of retirement, we think of, something like what the baby is doing, like just chilling and doing nothing. And for many years, I was thinking about that as well. But, now my thinking sort of has changed. And that is largely because I think of retirement as a way whereby we could begin our next phase of life. This is especially so when a lot of Singaporeans, the most recent study, we are beginning to live longer and longer, right? And living to 100 will actually be the norm for newborns by the time it reaches 2050. So there comes the question, right? Can we actually imagine not doing anything for 3 to 4 decades, post-retirement? And there's a lot of studies that actually show, like post-retirement, the biggest decline of cognitive power and also mental health is number one, you lack a sense of purpose or mission in life, and number two, you lack social life. And so when it comes to this, it becomes very important for us to begin reimagining what retirement could be like. And one framework I actually like to use is this flow state. Right, when we think about flow state, it is being completely involved in an activity for its own sake. Ego falls away, time flies. Every action, movement, and thought follows inevitably from the previous one, much like playing chess. Right? You think about it. When you're playing game, if it's too easy, you're not interested. Right? If it's too difficult, you give up. And when it comes to retirement, it is a chance whereby we could potentially think about and design our very own version of the game. Right? It's about finding what you love to do, and also what puts you in this flow state, such that you are able to continue to live a mission-driven life.
What does retirement look like to you, David? And how did you get this vision?
Okay, I mean, after working for almost 40 over years, I mean, by the time I retire, so these are, I mean, on the screen you can see these are all the things I wish to do when I retire. But this morning I learned something interesting. It's not retire, it's refire. I learned this word.
Sorry, say again. Refire.
Refire. So
Wow, I like that.
yeah, so instead of just chasing after this regular activity, also maybe I will take more time to actively participate in the CPF volunteer, so can share my experience and
Wei
knowledge
Jiin
with
is
all.
smiling. She's happy to hear that. So yeah, you want to stay active. That's what you want.
But in order to achieve all these goals, we must start young. So
How young?
Immediately.
Okay.
Yeah.
Okay. Yesterday. Wei Jin, what about you? You've heard both the gentlemen, very active life. Everybody talks about being in flow. You want to, stay mentally active, physically active, spiritually active, a lot of things, right? Wei Jin, what does retirement look like to you?
So to me, retirement is the next stage in life. It's not an end. A next stage where I can choose to do what's fulfilling personally. And I'm the kind that, I can't sit still. So I cannot imagine, sitting still, staying at home the whole day in retirement. I really hope that I can still be active, be able to exercise, be outdoors, and also learn new hobbies, pick up new things. So to do that, it's really important that I start to build up my health financially as well as physically, so that I can be prepared to enjoy this next phase of my life of refirement.
I like that. I feel like that's going to be quite a word that we're going to use. So let's talk about being refired, right? To refire well, you also have financial health. We want to make sure that we're achieving our financial goals. So how do you achieve those financial goals that you've set out for yourself and feel motivated to achieve that? Maybe David, we could start with you.
Okay. So since young, I was taught this phase. No one plans to fail, but we fail to plan. Okay. So definitely financial planning is a priority for me because I've been working in the financial institutions since in the 90s. So I understand the importance of that. And my first financial goal was when our son was born, Hector. So the need to save for his tertiary education is there. So that's where we started. Then on top of that, the second financial goal come when we career progresses and more saving. That's where we look into retirement planning. Then of course the good to have is the third goal, which is a legacy planning and leaving behind something for the next gen, right? So how does this process work? So me and my wife have a very structured way of doing it. It's a joint commitment between ourselves. So every 6 months we have something called like AGM.
I learned about this today and I said, this is amazing. I'm going to take it home and discuss it with my husband. So every 6 months, you and your wife, and this is like June or July? Just checking.
Okay.
Important.
July and Jan, because I use the data from end June and end December.
This guy. I love this model. There we go. This is a round of applause, from the gentleman
So
there.
how does it work? So basically, you have to consolidate all the asset that you have at this point in time, all the cash saving, investment portfolio return, CPF balances, SRS balances, indicative valuation of property, minus away all the liability, and you reach this number called net worth. So from this net worth, both of us will think, are we still on track on our retirement planning, on our retirement saving? If not, anything we need to tweak. And on top of that, sometimes we may have more liability. Then do we need to buy more insurance to take care of that need as well? Yeah. So and then we go away with the actionable plan, and we will review again, see whether all this actionable plan is taken care of.
That is amazing. This Excel sheet is very powerful. I love it, I love it. So what about you, Wei Jian? I mean, I see you nodding and talking about it, especially when David was chatting, right? What are your retirement financial goals?
Well, I think one's financial goal it will evolve over time because your life stage changes, your needs and wants, and your family needs changes. Well, for me, when I first started out, my main motivation was to attain that sense of self-sufficiency and some form of financial stability. My main motivation was that, well, my parents, they supported me and my brother financially, so I wanted to kind of like offload that financial pressure from them. I mean, they had to hold back, various aspects of their life. I remember that they didn't travel much, and they were also very prudent about even dining at restaurants occasionally. So when I started working, I wanted to really give them that financial space for them to be able to do what they want in life. Well, now that I'm a little bit more stable, I'm also starting to reflect on and think a little bit harder and starting to put the pieces in place for my future retirement. Yeah.
Yourself, Thomas, is the journey kind of the same?
I think for mine, the journey is a bit different. My first very serious financial goal actually started at age 17, right?
That's young.
Yeah, so like I think back then when I look at the people around me, there was a lot of suffering. So it was sort of like looking into my future, and I didn't want that. And I think if you look at this on the screen, for those of you who can tell what it is actually like pawn shop tickets. I think back when I was younger, my family had a lot of problem meeting with bills, right? So whenever the water or the power supply is cut off, that's where my mother had to do the very hard pain thing of, having to sell away all her jewelries. And when I look at this and I reflect on my life, I felt like, I need to get into university in order to get a better life, right? And the whole reason why I still had a roof over my head was because the house was fully paid off, right? And so it made me very adverse to taking on debt in life. And this led me to want to prepare sufficiently for my university fees, right? So when I went to the library, right, to seek role models and to read how do I do this, right? All books, they point to 3 principles. One is you always want to increase your earnings power. And 2 is there's no point to increasing the earnings power if you always spend what you earn, right? And number 3 is you always want to put the money to work into productive assets, right? And that is to invest your money. And so this is my financial goal at 17. It was to save 32,000, and the reason for this figure was because the school fees is about $8,000 a year for uni. I didn't want any debt, and so for 4 years there will be 32,000, right? And so what I did is I took out a lot of odd jobs. Back then when I was young, you had to figure out a way to increase that earnings. Also, back then, I was in Ngee Ann Polytechnic. That was when most of my peers were getting paid 500 to 700. I actually negotiated for about 2,000-ish. And the last thing is, of course, we want to learn how to do budgeting, right? You want to know what to say no to in life, right? And I mean, fortunately, I didn't have to spend that money. I allowed it to snowball because I was quite lucky. I got a scholarship, so I didn't have to use that money. So that sort of go into my freedom fund. So financial goals 101, right? First is you always want to know what the sum you need, right? Be it short-term or long-term goals. And then 2, you want to figure out the time horizon. And with this in mind, you're able to know like how much you need to save, how much you get to spend, and how much you get to invest. And lastly, right, to borrow the idea from Marie Kondo, you want to say no to activities you don't enjoy, right? Everything is a trade-off. It's not about depriving yourself of everything, but you need to figure out how to have a trade-off. The most important thing is you don't want to invest money in the stock market that you need within 5 years.
Okay, so we talk a lot about budgeting, right? So I think I'm going to go straight into that because what I've just gathered from all of this is that we all have different financial goals, which is fine, right? Whatever suits your needs. And I think it's important we plan. As David said, plan so that we have a clear plan to work towards as well. Every 6 months, I'm going to take that away from you. I'm going to learn. But the question I have is, how do you estimate how much you need for retirement? And what tools do you use? Maybe David, you're smiling here, so I'm going to go ahead with you, David.
Okay, definitely the best tool is the CPF tool, I must say that. But
good answer.
Yeah. So for myself, I guess I use an Excel spreadsheet. But I think the rule of thumb is let's try to stay debt-free by the time we turn 65. So no more debt to worry about at 65. So right now, I guess we must able to track what is our source of passive income when we retire. That can be our CPF life payout, investment from our portfolio, real estate, rental, maybe some joint business venture with friends. Then we also need to factor in what are the expenses we need. What is a good to have expenses, what is a must have expenses. Then the summation of all the expenses, then maybe we use a 4% to factor in inflation. So fast forward, let's say 20 years later, we will work out that this is how much roughly we need for retirement and whether we have the income to substantiate that. If not, better start planning harder now. Yeah.
Jiin, yourself?
Well, I like Excel as well. Something very satisfying about punching in the numbers and the formulas. But it's quite challenging because retirement can be many years ahead. So how do you like David, put in all the formulas and assumptions, right? But the good thing is that there are many tools out there. And there are some that I find quite useful. The first is the CPF Planner for retirement income for younger folks out there. So when you use the tool, it guides you to set your future retirement income goal by thinking about the kind of desired lifestyle that you'll be leading in your retirement. It then automatically projects, your CPF payouts for you, the amount of payout estimated that you could get at age 65. And then it provides you with some suggestions on how you could work towards that desired payout goal. For instance, topping up or making CPF transfers. So for members of the audience who are near retirement, not to worry, you're not left out. We have this CPF retirement planning service just for you. Through it, you can understand your different options. For example, how to boost your CPF payouts or how you can go about optimizing all the different decisions like which CPF life plan is suitable for you. Yeah, so you'll receive a special invite from us to use this service when you're reaching age 55 and 65. You could use the service digitally, or if you prefer, you can book an appointment with us for a personal chat with our CPF officers at the service center. Another tool that I use is the My Money Sense website. It has this feature, this financial dashboard feature that allows me to pull all my financial information from banks, CDP, and the insurers, so I can view everything in one place. So, in order to guide your decision, you need data, right? So this gives you at a glance view of things. And it also has this financial health check feature. It straight away tells you, how am I doing financially? And it points out to you any area that might need your immediate attention.
That's pretty cool to know that there are all these tools out there. Pretty nifty, right? Yourself, Thomas, are you also familiar with these tools or you've got others to recommend?
Yeah, I mean, I've checked out the CPF calculator. It's a very comprehensive one and I love it. So like if you guys want to figure out how much you need for retirement, definitely check out the calculator. But I'm also a bit old-fashioned, right? If you look at me, I'm the only one with the still using pen and paper here, right? So I like to do back of the envelope calculation. So like if you want a quick and dirty way of getting like a rough figure within 5 minutes, how much you need, I will actually use this AIM framework, right? So when it comes to this AIM framework, A stands for annual expenses, roughly how much you need to spend during your retirement by the time you reach your retirement age. And then you want to adjust that for inflation. You can take anywhere between 2 to 4%, but usually I just throw in a 3%. And then you want to minus any income, guaranteed income that you have, like for example, CPF Life, right? And then that is actually the amount you would need to save outside of what you are having in CPF Life, right? Using the 4% rule, you just multiply that figure by 25 times. And then you'll get the amount you actually need to save to prepare for retirement. So I just give you a very quick numerical example. So for example, if you're 33 years old this year, and you think that in today's dollar, your retirement expenses perhaps 30K, and then your expected CPF life is 10K, right? And then you have 32 years more, right? So how much do you need? Annual expenses, 30K. You adjust it for inflation, that's about $77,000. You minus the amount of CPF life guaranteed income you could get, right? Then you would need 67,363. Multiply that by 25 times, right? So you need to save this amount on top of what you are getting from CPF life. Yeah.
I mean, everybody's taking pictures of this formula. They're going to go home and calculate later on. But David, I saw you smiling, as Thomas was doing all these calculations and explaining it to us. And we've spoken about this a fair bit on the stage as well, about CPF, right? Leveraging CPF to achieve our financial goals. How have you done that, or what do you recommend? How can we use CPF and leverage CPF to achieve our retirement financial goals?
Yeah, I must say CPF is one of the core pillar for our retirement, right? So I think most of us also use CPF to do the housing purchase. So sometimes we get carried away. Like I heard from this morning, someone at this age still very indebted, almost 65, and still got million worth of dollars of debt they need to clear. So I guess we need to be more disciplined in using the CPF money. So for myself, when I decoupled my property, a big chunk of CPF came back. Then I realized that, wow, don't mess around with the compounding effect, quite enormous. So since that day, I've been telling all my friends, if possible, do a regular top up to do the housing refund. And beside that, if you can top up your special account to the full retirement sum, that will be very useful as well. And I also opt for enhanced retirement sum for bigger payout at 65, and I'm also using my supplementary retirement sum to supplement so that I can delay my CPF payout for a bigger payout after 65, maybe nearer to 70. Yeah.
All right, Wei Jiin nodding away. So I feel like you would also be very passionate about this, how we can leverage CPF.
It's really heartening to hear how David is leveraging on his CPF to help him build that strong foundation to layer on his financial plans. So I think everyone in the audience, you can also do that because everyone has a CPF, right? And the great thing is that ever since the first day you started working, you're already saving through your CPF contributions, right? Yeah, so this will then help you meet 3 basic retirement needs. The first is that it enables you to own a home, from which you can also unlock through monetization options later on when in your retirement years. And secondly, your CPF gives you that basic healthcare coverage as well. So your MediShield Life, it helps you to offset big ticket medical expenses. And in the unfortunate event of disability, CareShield Life can also provide cash payouts for a lifetime. And last but certainly not least, your CPF Life payouts, it will give you that lifetime income for as long as you live. So you never have to worry about running out of that basic level of payouts. Yeah, so other than that, in your retirement years, should you have immediate financial needs, you can also withdraw from your CPF up to $5,000 or more if you have already saved up and met your full retirement sum. So your contributions and the CPF interest rate will help to grow your nest egg in your CPF. So those of you out there below age 55, your CPF earns you up to 5% of very stable interest. And those who are older, 55 and above, is up to 6%. So beyond that, how else can you, boost your savings in your CPF? So you could consider making top-ups up to the full retirement sum in your special account if you're below 55, or even more up to the enhanced retirement sum, just like what David has done when you're 55 and above to your retirement account. And these are some 3 tips that I would like to share on how you could optimize your top-up. First, you could consider making cash top-up. So when you make cash top-up, you also enjoy tax relief savings up to $16,000 per year. So that's $8,000 of tax relief if you make cash top-ups for yourself, and another $8K if you are making top-ups to your loved ones. Alternatively, if you prefer not to have cash outlays, you can consider transferring your CPF to your special or retirement account for higher interest. But I also like to highlight that such cash top-ups and transfers, they are not reversible because it's a commitment to help you to reap that benefit of compound interest over a long period. So do think about your finances carefully, especially if you have housing commitments. And the last tip is that for eligible seniors out there, you get a dollar-for-dollar matching from the government of up to $600 per year for your top-ups under the Match Retirement Savings Scheme. So if you're eligible, or if you have parents who are eligible, do remember to make the top-up before year end so that you get this one-for-one deal. And another tip that I'd like to share is that many of my friends, they thought that, wow, make a lump sum top up, I got a lot of financial commitments. But you could also break it down. You could consider making small and very regular top-ups. So for example, a cash top-up of $50 per month, it will grow to $18,000, in 20 years' time. And that will then help you to have higher payouts when you retire. So the tip is that you have to start early. It's never too late to start though. And also make it a regular habit. For instance, you could put in a standing gyro instruction with us. Yeah, so that way you will never forget. So for myself, I have made very regular top-ups through CPF transfers. I've been regularly transferring a bit of my OA to special account over the years. And also I've been making cash top-ups for my mother because she's a housewife and enjoy a bit of tax relief savings along the way. Yeah, so planning ahead, I'm also considering topping up my retirement account later on when I turn age 55 up to the enhanced retirement sum so that I can maximize my CPF life payouts as my foundation.
That's very nice, and your wonderful daughter. Wonderful, of course. I noticed, Thomas, you were nodding away every time she said the word top up or she said the word payouts. Or I think it's particularly for the top up. Is that something you do as well? How have you been optimizing and leveraging CPF?
When it comes to investing especially, I think the past few years it has been extremely volatile, right? So in the course of my work, I get to speak to a few investors, right? They look very confident on camera, right? They are smiling, they're telling you where the market they think it will go. But actually, when the camera is off, when they tell me like, Thomas, actually, I'm wearing mouth guard to sleep every night, right? Because I'm chewing my molars out, right? And so like when it comes to investing in the stock market, it is a very stressful event, right? And especially as you grow older in life, you want something that serves as a solid anchor. And so that is what CPF is doing for me. It is a solid anchor to my portfolio while I take on the additional risk in the stock market. Right, and especially when it comes to using your CPF, I think many people know like it is to build your retirement. It is also it could be used for your housing also, but for myself, because there's still a very long runway, I also use it to invest in the stock market, especially during crises. So, for example, in 2020, when the stock market was drawing down extremely quickly, right? I was buying till I feel like puking, right? I was running out of cash, etc. Then that's where my CPF OA could be used to for my investment purposes.
Okay, now speaking of investment, I want to go straight into it. Investment advice for somebody who's starting out, perhaps. Like I'm starting out as well. So, David, could you give us some investment advice to someone who's fresh?
Okay. Before we start investing, I always believe we need to set aside our emergency saving in case some emergency or crisis crop up. Rule of thumb is minimum 6 months of our income set aside for emergency. Then on top of that, I like to segregate my saving to 2 pots, the active and the passive pot. What do we mean by passive pot? Passive pot is the core for the portfolio, is a core for the saving, the core portfolio, something that is stable, something that don't really fluctuate a lot. So build that pot first before we look elsewhere into the active pot. So for that pot, what instrument I put inside? Definitely the CPF. After CPF, life insurance, T-bills, annuity. So that will help to build towards the retirement. So, okay, when you have something extra after you build that pot, so I will look into the active pot or the speculative pot where I can consult Thomas in what shares to buy and hopefully can make some money out of there. But be mindful that it cuts both ways. Sometimes you not enough holding power, hear from friend, buy the wrong stock, and that's why you tend to get very disappointed with the outcome for that pot. So key factors are all mentioned now there. Is that aligned to your risk appetite? Are you able to meet a time horizon? What is the cost versus benefit? The last thing you want is big investment, big risk but small return. Then it's a capital protected. Are you able to achieve diversification? Are you able to commit on the regular top up for the investment? So I guess for this part, it's good to speak to your trusted advisor from the banks and the insurance industry, insurance company. I mean, yeah.
A few people nodding in front. I think within the industry for sure, yeah. Thomas, I also saw you nodding. But when it comes to investing, right? Let's talk about the basics. Where should we start? What should we consider?
Yeah, I fully agree with David on how you need to make sure, very important, make sure your emergency funds are prepared, and then you want to make sure your insurance, all this is sorted out, because you always want to prevent the market from shaking you out, right? Because you want to grow your wealth for the long term. And when it comes to investing, I think it's a very noisy world out there. And number one is I'm going to show you how to filter out the noise, right? Because there's 1,001 things to focus on. So where should we direct our attention? So when it comes to investing, I like to use this framework. We need to first figure out what's important, right? So for example, a lot of people like to ask like where the interest rate is going, where inflation is going. These are important questions, right? And then what the business results are doing, right? And then also asset allocation, how diversified you want to be. All these are important, but not all of them are knowable, right? So what's knowable? It is your economic forecast. Whether they are right or wrong, very likely they are going to be wrong, right? Because if they are right all the time, they are going to be rich, right? There's no forecasters who are extremely rich, right? They're going to be wrong most of the time. What's knowable? Business results. How the businesses have been performing over the past few years, that is knowable. And again, your asset allocation. And the key thing to focus on when it comes to investing is the overlap in between. That's where you want to put your focus on, right? Rather than asking where the interest rate is going, to be honest, in the most recent Fed chairman, his meeting minutes I was reading, even he himself don't really know where the interest rate will go, right? Because there's a lot of moving parts and he has to react to all these moving parts. So what we want to focus on is if the interest rate were to move, if it were to go up, which company would benefit, right? Or which company would suffer? Which company is having a lot of debt on its balance sheet, such that when they refinance, there's going to be a lot of expenses. So when it comes to investing in businesses, that's where we want to put our focus on. There's a lot of information out there that's so-called free, right? But it's never free, right? Because information consumes your attention, and a wealth of information will create a poverty of attention. So we want to put our attention into the things that really matter. Okay, the second thing, right, to borrow a quote from Warren Buffett, right, the best investor in the world. So the Mr. Market is there to serve you, not to guide you. And what I mean by this is this. When we look at the stock market, right, here are three things we can draw from this table. This is a list of all the crashes there is in the stock market. And three things to note is that one is that stock market crashes should not be a surprise. It is going to come. And what we need to do is we need to take note of what David has said earlier about preparing for these market crashes, right? Number two is that you notice that in the most recent financial crisis, they are becoming more and more frequent, right? For the investor who is ready, it's pockets of opportunity every now and then, right? And the third thing that you notice is that it always recovers, to its previous peak and then more, right? But the truth is, on hindsight, we know that this will recover. But we are going through all these crises, right? It could be the Asian financial crisis in 1997. It could be the subprime mortgage crisis in 2008, right? Or even the most recent one, the COVID scare. It will look like, all hell is breaking loose. It's not a good time to invest. Knife is falling, right? But that is, what we will experience as investors as we are going through all this, right? So what we want to do is we always want to make sure that we are on a solid foundation, right? Don't invest on borrowed money. Don't be too over-concentrated. Okay, so this is how frequent the market drawdown, right? 10% every 11 months, 15% every 2 years, 20% every 4 years, right? So it is something to be expected, and we have to be prepared for this, right? And so, but the next 3 points is in order to best prepare ourselves for these market drawdowns, we want to make sure that number one, like what David said, we need to have emergency funds ready, at least 6 to 12 months. 2 is you must make sure that you are adequately insured, meaning all your medical expenses, etc., right? Those must be taken care of because those are going to cost a lot. And number 3 is for all your short-term investment goals, right? That's under 5 years, don't use that money in the stock market because the market will never know when you need the money.
Okay, David, I think off stage we were talking about the various market crashes. Maybe you may want to add to that and your experience and how you're preparing potentially, if at all. Because we had the COVID one recently, and we saw, so that according to that last slide, there's 6 months, right? You are smiling. Tell me how you are preparing or what you've learned.
Okay. Allow me to share a story. So when I first started working in the 90s, Singapore is booming. Together, the whole Asia is booming. So Singapore, South Korea, Taiwan, Hong Kong are known as the 4 little dragons. So all the business here expanding, people are all doing very well. So a lot of companies are expanding, going public listed so they can raise capital to grow the business bigger. So back then, every time when a company go IPO, you apply, subscribe for the share, you get it on the first day trading, easily up 10, 20, 30%. So wow, easy money, right? So everyone was forming a beeline, at the ATM machine when there's a new IPO. Don't care what company, as long as it's listed means good. So just apply. And they learn from friends. Hey, how much you apply? 10,000, I must beat you. So they get more subscription. I will pour in all my saving. And on top of that, I may even borrow money from the credit card since a few days only, right? And most of the time the allocation is small. So this is how crazy it gets. So here comes the 1998 Asia financial crisis. All these they have bought would have lost almost 60, 70, or even 80% of the value. So what have we learned from this episode? Herd mentality. When your friend do it, I also want to do it. Lack of research and knowledge. Since everybody making money, so it should be safe. Being kiasu, so I must outperform my friend. My friend buy 10,000, I must buy 100,000, so I can more to boast. And worst of all, I say to wrap this up, don't be greedy. So with the word greed, it can set you back a lot if you on this failed investment. Yep.
Wei Jin, you're nodding. Don't be greedy. I think you nodded the most violently at that one. But we're still talking about investment advice, though. So what investment advice have you got for us?
I think I must thank Thomas and David for their very comprehensive sharing and the
Yeah.
wise words from David. Not much else to add, but really to emphasize that before you jump in, really understand your investment horizon. So your horizon and your risk appetite, you must be able to ride out the storms, that could happen from time to time, because they will happen, right? So also take the time to research a product. Be honest with yourself, right? Are you just being kiasu speculating, or is it really investing for the long run to grow your wealth? Yeah, so do be careful. I think for those of us who are just starting out, if you already have set aside some emergency cash and met your financial needs, and you have some excess savings which are starting out, you could first start on some more straightforward, relatively risk-free options. And there are such options out there. For instance, the Singapore savings bonds is relatively easy. You can read a bit more about it on the MS website. The good thing about it is that you can exit it any month that you like. You can liquidate it without incurring any penalty cost. Yeah.
So, I mean, those are some options that we can consider, especially if you're starting out. And do your homework, right? I think don't follow herd mentality, don't be greedy. What are some challenges that you guys have faced when it comes to investments and that you can share with us, lessons that you've learned? Thomas, maybe you can start us off.
Yeah, so I think one of the biggest mistakes I see a lot of investors make is taking off excessive risk by over-concentrating in any single asset or any single stocks for this matter, right? And one of the example that I read last year was there was a Singapore influencer, quite famous. He sold his HDB to all in on one stock, right? I don't know whether you guys know, some of you are smiling. Maybe you guys know who he is.
I think they've heard the story.
I think you all heard the story. It's Stephen Lim, right? He all in on one company called SingPost, right, at 65 cents. Now, before you all take the phone to check like how much it is today, it is about 49 cents, right? So the 3-room flat sort of got downsized a little bit. So when it comes to investing, the biggest mistake we can make as an investor is to become a bit too aggressive, a bit too confident with our position. When it comes to investing, we always want to take care of the downside first. There will always be things that we don't know, right? That could hit us in the rear view, right? Things that we don't see. And so to take a conservative approach when it comes to diversification, especially if you are investing in the stock market. So a good gauge as to how many stocks you should own based on a few research is about 8 to 30 stocks, right? That way, you're able to diversify most of the market risk. So if you're investing in the stock market, that's the number you want to go to. But the thing about owning too many, it's the number of stocks you want to own is a bit like parenthood, right? You don't want to have more than you can manage, right? So when it comes to investing, I think a sweet spot is generally between 10 to 20 stocks, right? If you're investing in the stock market. You want to make sure you're adequately diversified, yet you don't want to lose track of your investment. When it comes to active investing, you must understand what you are investing in, right? You must know the companies behind every single ticker.
Any challenges? David, I feel like with your 6-month review, what are your learnings? Share your challenges when it comes to investments.
Okay, the challenges is always you feel that you have not invest enough, so the return is not attractive enough. So sometimes we get carried away and say this investment will not fail, sure make money. So what you do is you backsteal and borrow, all in, like what he mentioned, and that is the pitfall. If you don't see your blind spot, I would say, then later you realize that you can't pay back the loan that you took. Yeah, and before investment, I always believe in what is the core that we are going after. The core is definitely something that is stable, that is safe. So like what covered earlier, are we adequately insured? I think that's important. Have we set aside enough the CPF money? I think that's important. Something that will not jeopardize your long-term plan. So equity investment or some other speculative investment, like recently people talk about crypto, etc. and all this. So I will always take it with a pinch of salt. So will not overindulge in that area. So the last thing also, sometimes you take advice from your beer buddies, and so it's quite bad. So they tell you sure make money, just go. Yeah, so it can turn out to be pretty wrong sometimes. So yeah.
You seem to have this recurring theme of don't take advice from, like don't take like hurt advice. You seem to have that as a recurring theme. Wei Jiin, you seem to be nodding at that point about advice, and you were smiling. What advice have you got for us?
It's quite interesting, hearing the sharing. And I think those who are a little bit like my age, right? Remember when I first started, trying to learn about all these financial planning stuff? There's so little information out there. You have to literally take a bus to the library, right? Or talk to your kopi kakis or consult other people who might have done it before. But the great thing is that now there's so much more resources, online, everywhere, right? But that's also a downside because there's so much information out there and so many different point of views and philosophy and strategy. So how do you make sense of that? Yeah. So one resource that I find quite useful is the Money Sense website. My colleagues, they have taken the trouble to pull together some information as a source of neutral information that everyone can go to do some fact checking and get your basics right. So just this morning, Minister Ong, he announced the launch of the Basic Financial Planning Guide, right, which the MAS, the Finance Industry Associations, together with inputs from CPF board, they've put together. So what this guide has is that it provides you with a one-page summary, right, of the important things that you need to take note of and some useful information in terms of like savings, setting up your emergency cash, investing for retirement, your CPF, insurance, and even legacy planning. So I think I urge all of you to check it out. It's available on the Money Sense website. You can go take a look, and it can help you to kickstart your financial planning journey.
That's fantastic. Thank you so much for the sharing. We have loads of questions coming through. I'm just staring at them. Thank you so much for all your questions. Before we head to Q&A, maybe some final thoughts perhaps, or we can even wrap up even more final thoughts later on. Any other words of advice that you hope people knew or at your age?
I think apart from not over-concentrating on your investment, another hard no when it comes to investing in the stock market is definitely do not leverage. Don't borrow money to invest, right? Because oftentimes the market can remain irrational, then you can remain solvent. And throughout the past 2 to 3 years, I've seen a lot of very seasoned investors who are managing like pretty big sums. They are forced out of the market simply because they took on more speculative positions, right? Especially when it comes to leverage. Once you get margin called, you will be forced out. And when it comes to compounding your wealth, you always want to make sure that it is consistent, it is steady, and you want to grow it for the long term, right? So protection of capital is always number one.
Wei Jiin nodding away at the protection of capital. Do you have thoughts on those on that topic as well?
I think one way to think about it is this curve that many of you may have seen. How then do you guide your accumulation of your wealth and the subsequent decumulation? You want to do it in a way that it aligns with your planned lifestyle, when you plan to retire and what you plan to do. And also to protect that curve, right? You must think of that protection layer, the insurance or the emergency cash that you need to put in place so as to protect your plans.
David?
Okay, I guess education must start young, yeah. So instill the right money sense in the children, teach them the importance of savings so that they spend within their means. So instead of giving weekly pocket money, maybe monthly or maybe every school term, so they let them have a sense of managing their money.
So they learn to budget at a young age.
Usually what happens is that when my child managed to generate some savings after he spent, I will double the amount and put it in the bank for him.
that's
So
good
they
incentive.
learn, to incentivize them.
I like that. Yes, the great ideas that we're getting. Okay, I believe we are going to go straight into Q&A. We have so many questions. Keep them coming. We've got Mentimeter, so you can submit your questions as we go along. Okay, so I'm just going to go straight into the first question. As older people have a shorter horizon to invest their money, what recommendations do you suggest to help to grow, to get the most value out of their money? Thomas, maybe we can start with you.
Yeah, so I think like as you are drawing closer to retirement, the amount of asset allocation has to change, right? It cannot be 100% equity in the stock market. I think that's where your CPF come in, and then that's where also other annuity plan or other fixed deposit plan may come in. So you want to shift between, asset allocation as you go closer to retirement or when you start to retire. Because when it comes to investing, the market will not know when you need the money, right? So the last thing you want to do is you want to withdraw during market drawdowns like this, right? So for now, like for people who have more than 2 to 3 decades, and again, it depends on your risk appetite, then you can shift perhaps like 60 to 80% or even higher into the stock market. But as you go closer, perhaps you want a 50-50 approach or more in bonds if you want to have a bigger peace of mind.
David?
Okay, agreed with what Thomas said. So the last thing we want, the last pot of saving we have, we lose it everything in the stock market. Then it become depression and you start to fall sick and everything just spiral downwards, So most important is that as long as we invest in something that is safe, I suggest better top up the CPF. If you have not top up enough, at least have a peace of mind, right? So the money is always there, top up and get a bigger payout. So anything extra, then maybe we dabble into some more speculative investment. I was sharing just now that pie where the passive versus the active. The speculative pot, as you age, the proportion allocate to that should shrink. Yeah, from maybe 60-40 to maybe 70-30, 80-20, because you don't want to lose all your hard-earned saving at the old age. It's quite sad if that happens.
Of course, absolutely. And we want to avoid that at all costs, right? Wei Jin, topping up? Is that one of your advice as well?
I think that's why many of our members at around age 55 or 65, they like to come and have a conversation with us to understand their options. So there are some easy options that you could take to maximize your CPF. For instance, if you don't, you're still working or you don't need the monthly payout, you could delay the start of your payout to age 70. So for every year that you choose not to start, your CPF would grow by up to 7%. Yeah. And other options could be topping up, of course. Also, take a look at your CPF savings. If you don't really have a need to withdraw your excess from your OA and SA, you could leave it there to enjoy the CPF interest so that you still preserve that option in the future should you need to use it as rainy day funds. Then, of course, do your sums like estimate how much payouts you'll be getting versus how much you'll be needing and then see how much you want to put in. So like I mentioned earlier on, there are also home monetization options for those of you who own HDB flats. So you could consider the lease buyback scheme or the silver housing bonus scheme if you were to right-size your property. Yeah.
So speaking of top up, I think we have a question. I'll stay with you, Wei Jin. If I top up my retirement account at the beginning of the month, if I top up my retirement account, there we go, at the beginning of the month, I will only get interest on the amount which I topped up beginning next month? Is that correct?
Yeah, this person is quite CPF smart. So
Yes.
with any new contributions that come into your CPF account, it will start earning CPF interest rate the next month. So if you were to make a cash top up or you receive working contributions, these monies together with your whole pot will earn the interest from the next month onwards. Yeah.
And I may just stay with you a little bit because it's also a bit more of a technical question. Can I set up a personal chat with a personal CPF planner before the age of 55?
So you can use the CPF planner that I mentioned digitally. But of course, if you still have further questions, burning questions, feel free to approach us. You can write to us, or you could go to our website to book an appointment at your preferred timing and preferred service center to have that chat with us.
Okay, I'm going to switch gears a little bit, talking about freelancing. This is the next question that has come through. What is your advice to our panel here? What is your advice for freelancers or self-employed when it comes to CPF? Because you don't contribute to OA or SA, and yet there are no tax reductions. Yes, Thomas, nodding away.
Yeah, so I think when it comes to preparing for a retirement, right, it's either you could just top up into your SA directly. That way you can get to save on your income tax, actually. I believe up to $7,000 every single year, right? Other than that, you can also consider buying into index funds if active stock picking is not your thing, right? For freelancers, definitely when it comes to managing your own personal finance matters, I generally try to keep about 2 years worth of expenses, right? It is not the most efficient way of using money, but it gives me a peace of mind that I need to do creative work or to invest in the stock market, right? Because ultimately, peace of mind is necessary to do good work and also to stay the cost of compounding.
David, advice for the self-employed?
Okay, agree with what Thomas said. So if you are a freelancer, there's no clear stream of income. So like what you say, setting aside a bigger amount for rainy days are important. So when setting aside, you don't put in the bank that pay 0 interest, right? So minimally, you may put fixed deposit 6 months, a few tranches, so that every 3 months there's some money coming back. At least you get some interest out of it. But on top of that, wherever you can set aside and you got no time to manage, or you can talk to your insurance agent, maybe get an annuity. That at a certain age onwards, you may receive a payout, which can also help to supplement retirement.
Wei Jin, would you like to?
I have some good news. So it's the tax relief has gone up. If you were to contribute to your special account, it's no longer $7,000 but $8,000.
Nice, awesome. The happiness on your face, I love it. I'm just going to be moving on and switching gears again, because we're going to be talking about financial habits. Maybe I'll start with David, and then we will just move along. What other financial habits, aside from the ones that you have already shared, what other financial habits can you share that perhaps we can practice?
I mean, since young, I've been brought up in a very humble family also. So we are being taught to be prudent. Don't overspend. So before we spend money, right, it's a bigger ticket item, especially like, for example, buying a car, going for expensive holiday. It's definitely going to be a collective decision between myself and my spouse. So we will talk about this. So is this a good to have, or is this a must have? For example, do we need to go around in the expensive car, or just a normal car will do the job? So that make a lot of difference. And for holiday, do we need to really fly by business class, or economy class also works? Budget air, hotel as well. Do we need to have expensive dining on a very regular basis? Yeah. So I guess that one is important. So your children also learn from you. So if you spend at no tomorrow, then they also get influenced by you. They will spend at no tomorrow.
So give consideration to big ticket items and luxurious experiences. Wei Jin, some advice?
So for myself, to instill that habit, right, I make it automatic. So,
Gyro.
Yeah. So when I have separate accounts, so when my salary comes in, I make sure that I segregate the long-term savings from my operating account, so that I'm not enticed to use too much. So I set up some automatic transfers instructions, and I work within that budget. And of course, beyond the day-to-day needs, if I do have some holiday plans or some planned desired purchases, I would also save up for it, and not. My goal was to general rule of thumb is not to spend more than the inflow. Yeah, and also watch out in terms of like credit card debts and all that, to make sure that everything is on top, and that's always a net increase in my overall wealth.
Yeah, before, yeah, one more thing. So when we're younger, we tend to be more aggressive. We keep thinking like, we can spend future money. What do you mean future money? Oh, my bonus get paid in December. Spend first. It's okay. Credit card whack. Let the December comes, then the bonus will come. Then we'll settle all these expenses now. But the problem is, if December come, the bonus was not there as what you expected. then you run into a credit card debt with a compounding interest of 36%. That's no joke. Yeah.
Okay, never spend future money. Agree?
Yeah, I mean, definitely agree with that. So for myself, I generally have a few big bucket of expenses, right? After I do my own planning on an annual basis, then that's where I'll put like, traveling bucket this year, how much do I get to spend? Restaurant bucket, how much do I get to spend, right? And then I just make sure I don't exceed all these expenses. So it becomes less friction, like because the moment we make it too complicated, for example, we track every single expenses, usually that is not sustainable, right? Anything we do, we must think about how sustainable it is for our daily life as well. If it's too complicated, we will not do it. So I just like to have a few big buckets and I don't exceed those buckets.
Just to add, I agree that it's not sustainable to track every single thing. But if you have not done that before, it might be useful because I did that at the start. It's just to get a sense of how much you're spending, because on a day-to-day, you can't track, and you wouldn't know, right? So you might want to do that for 1 or 2 months so that you get a sense of your expenditure patterns, see what's really necessary and what you could cut, or actually what you could spend a little bit more so that you don't torture yourself, right? It's a balance, right? You want to save for the future, and yet you still want to enjoy life for now.
But also where the bulk of your money is going as well. Sometimes it's good to know, oh, I had no idea I spent so much on food delivery or so much on transport, right? Then you may just want to change your lifestyle a little bit. So we're going to be talking about investments next. There's a question here about how you can tell. How do I tell between a good investment and a bad investment? Nodding away. I feel like the entire panel has got thoughts on that. Maybe Thomas, we can start with you.
I think there's a lot of things we need to take into account when we are investing. But if there's only one question I can ask myself, why does this company deserve to be bigger 10 years from today? Right? Because that question will answer a few things, right? Why this company will have a competitive advantage against its competitors? Why does it deserve to continue grabbing market share? Because ultimately, at the end of the day, the share price is going to track the business fundamentals, right? And then the next thing I want to take note is a good business can be a bad investment if you pay too high a price, right? Then you want to perform some form of valuation to decide if, is there a margin of safety when it comes to when I'm purchasing today's investment, right? If we are looking at the other flip side, you're looking at investing in funds or indexing, then we want to look at what is the cost. Because cost is very important when it comes to investing. You don't want to let all these costs eat up all your returns, right? And then we want to look at the long-term track record if you are investing in any of the fund managers, right? Not just 1 to 3 years. I think the biggest mistake is to only look at 1 to 2 years. This fund manager, they make a lot of money. But no, you always want to look at, 5 to 10 years at least. How have they been delivering on their portfolio, right?
How do you segregate good and bad investment? So before that, I always believe one thing when I was managing our clients' money: prudent risk taking. Yeah, no such thing as too good to be true and definitely make money. No such thing. It's all about prudent risk taking, right? So herd mentality is important. When the whole world is telling me, well, Bitcoin is the only thing to go, and then you're very careful herd mentality. Maybe I also share with you then example back in the before the Asia financial crisis. Everybody is talking about stock market. Housewife in the wet market, even taxi driver, they're all talking about stock market. Which stock to buy? Because some even tell me just buy the one with the highest volume, sure make money one. It's as simple as that. So you will lose out if you don't. So I mean, I have a favorite food court store. Even the wonton noodle seller was not even having eye contact with me when I make my order. He was looking at the teletext screen where the stock price is flipping. You ask me, you want chili, dry, soup? He no eye contact. But guess what? Right after the financial crisis, even the store was full up. You can't afford to keep the store. Quite pretty sad. Yeah.
So I mean, we've got a lot of lessons here that we're learning, and we've got a question here. Okay, let me just move on to the next one. For best returns, is there any right time to enter the market? Right time, wrong time, or there's no right time? Maybe we'll.
I think when it comes to investing, right, especially if you are doing active stock picking, you definitely don't want to invest in companies that are too overvalued. Especially like when we look at 2020 to 2021, there was a huge bull run, right? And a lot of these companies, they went into price of sales ratio of more than 30 times. Some even went up all the way to 100 times, right? And when the market is that bubbly, I wouldn't recommend people to start buying into all these companies. But if you have a long runway, right, the odds of you losing money if you were to buy the entire index, right, that is the S&P 500, not individual stock picking, the odds of you losing money actually diminishes with time, right? And based on historical results, if your time ownership is at least 17 years, historical results, almost you will not lose money, right? Almost 0% whereby you will lose money. So it depends a lot on your horizon, right? But when it comes to active investing, individual stocks, there is such a thing as way too expensive. But if you are indexing, buying regularly, and you have no interest in analyzing the stock market, usually a DCA approach is pretty reasonable advice.
Okay, we're going to move on to our next question. We've got so many, so thank you very much for all your questions. If I have fulfilled my full sum for CPF Life, can I still put my extra money into the SA Auto Grow my CPF Life? I think that's a question for you, Jiin, perhaps.
So just for everyone's info, if you're already above age 55, you can top up your retirement account up to the enhanced retirement sum. This year it's 298,200. So that if you have that at age 55, you will get CPF payout about $2,300 per month. So if you've already maxed it out, I'm sorry you can't like put in any more to your retirement account and CPF Life, but you could consider other options. For instance, the supplementary retirement scheme, which is run by MOF, which allows you to put in money and also invest it for your retirement needs. Alternatively, if say you would like to have a little bit more in your MediSave account for your healthcare needs, you can still top it up to the basic healthcare sum. This year, if I remember, it's 6,000...
8,500.
Wow, thanks, David.
Okay, moving on to the next question. What advice do you have for a 45-year-old who just became a PR to build savings for retirement? The investment and savings horizon appears short. Anybody want to, whoever would like to take the script? Thomas, would you like to start first?
I think 45 is still, I mean, there's still enough time. I think there's still a solid 2 decades before you retire. But I think the number one thing to do is to first figure out what is the amount you need for sufficient retirement, because it is different based on everybody's expenses, right? And when you're able to get that nailed down, that's where you get your blueprint on how much you need to earn, how much you need to save, and how much you need to invest, right? You can't control the rate of investment you get, but what you can do is you can control the other 2 elements, how much you actually earn and how much you actually save, right? So we want to make sure we get that blueprint out first, and then we work backwards from there.
Yeah, on top of that, make sure you are adequately covered in terms of the insurance need. So you don't want something unprecedented happen to you and your spouse, and the children are left behind cold because all their financial commitment for them are all being disrupted. So that's very important as well.
So there's an interesting question coming through as well, which starts with a quote. And the quote says, okay, I'm just going to get to it. If you've won the game, stop playing. Quote from Bill Bernstein, I believe. So I believe I have enough for retirement. I've got $1 million in FDs, T-bills, SSB and all that. How do I decumulate wisely?
Okay.
He
also points out to another thing that I have in mind. They call that, are you going to apply SKI? What do you mean by SKI? Spending kid inheritance. Or how much you leave for your kids. So I guess every household are different. Some would prefer to leave something meaningful for them. Some will say that never mind, they are as long as I provide them with education, so they can be fun, they can make their own money. So as I said, different family, they have a different way of approaching this. But most important thing, have this conversation with your spouse, because this is a joint effort thing to see how much. Usually, mommy want to save a bit more for the next gen. Yeah.
I think I recently read a book that touches on this topic. That book name is called Die with Zero, right? The ideas is a little bit different from what we are taught in the Asian context, whereby we save and save and save, and then, we leave a legacy behind, right? But at the same time, the book challenges this thought, and not saying that we should follow it. I'm still letting it marinate in my head, but it's the idea that we should start consuming and stop aggressively over saving. So like for this person right here, he already saved enough. You want to think about how you want to spend it while your children are still in their maybe early years or in their prime years. Because a lot of times when we leave legacy behind for our children, let's say we leave it at 80 or 90 years old, your children is already 60 to 70 by then, right? They can't really do the things they could have done when they were 20 or 30. And also like all that time you spend hustling, working overtime, not being able to spend with your children while they were younger, those time actually perhaps you could dial back a bit and then spend more time with them while they are young, right? Because they are going to grow up very fast and you will not be able to get those time back. So when it comes to this, again, it's very important to have the blueprint so you know roughly where you are in your retirement plan saving. As much as it is dangerous to, under-save for retirement, it's also risky to over-save for retirement because there are certain things you will miss out in life that you will never get back and experiences, right?
May I add also, when you say that, how do I know that I have enough, how to decumulate wisely? That's a very tricky part because we don't know when is our expiry date, for sure. Nobody knows. We are not fortune tellers. So if you have 10 years, if you think that you have 10 years, but you live more than 10 years, maybe 20, then you run out of saving how? So definitely CPF life is important, yeah. So if you have don't estimate correctly, at least the CPF life part will still help you.
Yeah, I think that's a very good point. We never know when's our expiry date. So that's the part where CPF Life can give you that assurance or that peace of mind because you will always be guaranteed to have that monthly payout no matter what happens. Yeah, so I also read that book, Die with Zero. So it's quite an interesting thought. So it's really about also thinking about how you would spend your decumulation on. So it's not about like acquiring more material things and all that, but really like, using that money to better fulfill your purpose in that phase in life. And, some people, they share that, it's about then spending that money to acquire more experience or spending that money to be able to give back to society or your next generation. So I think decumulating wisely, it's not just about money, but also what then do you choose to do with that money to make your life more fulfilling?
So I'm just going to switch gears now, talking about your investment mindsets, right? Could you share some investing mindsets for beginners? I know we've touched on that, but what's the crucial one? Are there a few basic principles that you advise for beginners? Perhaps maybe David, yeah.
I guess before you even start investing, right? So why do you want to invest? Because you want our money to work harder for us. That's why we want to invest, to want to outperform inflation to begin with. So before we do that, then we must sit down and say, what is the goal of this saving? Is it to save for my children's education, save for my retirement, save for down payment for my next property, for upgrading? So why are we saving? That's the key. We must ask ourselves, and how much time we have, and are we able to allocate more to the riskier assets if you have a longer investment time horizon? Yep.
Yeah, I think while it's easy to say like buy low, sell high, right? But it is actually very, very difficult to do. And oftentimes we see investors, if you will look at the broad market, right? Usually investors will start investing at the height of the bull market, right? Just right before it collapsed, right? And once it collapses, the money will actually, you can see the money flowing into the bond market. Then people want safer things. So investors are always doing what they're supposed to do, the opposite thing, right? We take action when we shouldn't, and we stop taking action when we should. So when it comes to investing, not just you need to be mindful of this. Doesn't mean when it starts falling, you go and buy. We also need to be very honest with ourselves. Do we have the time and energy to do stock analysis, right? Otherwise, you could consider just adding to your CPF, or you could just index, or you could just buy into funds, right? This way, you free up that time to do other things in life, right? So when it comes to this, the mindset, the psychology is very important.
So these are some investing mindsets. Is that all aligned with your personal experience as well? Your actual investing?
Yeah, so I have a few rules set in place because I think when it comes to the investing, humans are not really wired to be very good investors, right? Because at a sign of danger, let's say if there's a lion at the exit, everybody will be rushing out today. And same thing, when the stock market is falling, it will trigger, a very primitive part of our brain whereby we want to sell. And so for myself, I have a few hard rules, like if the stock market drops several percentages point, I must buy, no matter how much I feel like puking, right? Even until today, I've been investing for like maybe 14, 15 years. Every time I buy during a drawdown, I still get that very uneasy feeling, right? And that is usually the time whereby I have to start clicking the buy button. But of course, all the work come beforehand, right? Because when you're going through a market drawdown, you won't be able to think very clearly, right? And so you need to have a battle plan prepared before the drawdown happens. That's where all your research and everything would be put into good use.
All right, we've got just a last couple of questions here. Are REITs a good source of passive income?
Okay, I guess when the interest rate environment was very low just a few years ago, many people are using REITs, especially the Singapore REITs, that as an alternative source to get a more return versus the fixed deposit. I mean, back then fixed deposit was paying as low as 0.5%, 1% back then. Of course, recently, if you take the look at the REITs, I think you see the price start to correct quite a fair bit. Maybe from the peak, 25%. I think they have 25% correction. Why is that so? Because the risk-free rate is very high now. What by risk-free rate? So like what the SGS T-bills. So 6 months pay almost 4%, right? For not taking risk. Yeah, so you must compensate that if I want to take risk. So what is the risk premium we're looking at? So for REITs right now, if for the REITs to be attractive, the yield must be about 7% at least. So take away the risk-free, and that's the premium we're going to get. On top of that, risk manager also face a lot of challenges because some of the REITs also, they took loan, yeah. So when they took loans for the REITs as a fund manager, the risk manager, the borrowing cost is actually very high now. Yep. I think, if I'm not wrong, for US dollars, you're paying almost 6%. I think for Sing, easily 5+%. If you're a good borrower, you're not a good borrower, you're high credit rating, even higher. So the cost, the interest cost expenses is very high now.
Yeah, I think anybody investing in the stock market, you must always remember this. When it comes to looking at investments, you always need to take into account three things, right? And that is your total shareholder returns. It is made up of first, 1, your dividends, 2, if the company is buying back shares, and 3, that is your capital gains or losses. And for a lot of investors, when we are looking at REITs or other dividend counters, right, we always only look at the dividend yield. But what if you're making like 5-6% in dividend, but the share price actually dropped, maybe it dropped 30-40%, right? Then your returns would actually go down from there. So if you're looking strictly for passive source of income, REITs is one source, but you always want to do your analysis such that, is this company, is the REIT manager a good one? Do they do asset enhancement initiative whereby, it actually puts the REIT in a better position going into the future? Because ultimately, REITs are instruments that are highly leveraged, meaning they borrow a lot of money, like up to 50% of their asset value, right? And so they're usually susceptible to two things, or rather interest rate, right? It will affect them in two ways. One is when they refinance at a higher interest rate environment, the amount of distributable income will start declining. And 2, the share price will generally decline with interest rate increases. Why? Because investors are always looking to measure, what is the best alternative out there, right? If the REIT is giving me 5 to 6% and the T-bill is perhaps maybe giving me 4%, does it still make sense for me to invest in a risky asset, right? So we always want to be aware of this thing.
I think we're just about wrapping up our session very soon on stage. Final words? Ladies first.
I hope that today's session has been useful. So for those of us who have not embarked on your financial planning journey, hopefully that today you feel inspired to start planning for your retirement. And for those of us who already have plans in place, maybe after today, go back and take a review of your plans, start planning a little bit more ahead, and see what refinements or tweaks you could do with what you have learned from today. Yeah.
Okay, still the face on no one plan to fail, but people fail to plan. So instill this saving habit on the children. So that's something that I think the children can learn young. Collective responsibility between yourself and your spouse. so that both of us are journeying this thing together, and we start young on that. And never be too impulsive and have this greed element that and a kiasu mentalism. Yeah, just to invest and you sure make money kind of thing, which will never happen.
Yeah, I think our audience here today generally, they care about retirement, they care about prudence and all that. But another aspect we want to take into account, especially when it comes to retirement, is it is a beginning of a new phase in your life, and you want to learn how to design that game such that you continue to live with a mission, with a purpose. So that next phase is important, and you get to design that for yourself.
Amazing. And I think on that positive note, on redesigning or designing your retirement, ladies and gentlemen, could you please, with a warm round of applause, thank our esteemed panel today. Thank you for sharing all your thoughts and your time as well. At this point, before I let my panel go, we're just going to be flashing a QR code on the screens. I know we've been taking a lot of pictures as well. If you could kindly help us with a bit of feedback, we always love to hear from you to make our events even better with each time. And with that, thank you very much to our panel. We've got lots of booths outside as well. If you are curious to know more, you can understand there's so many educational booths out there. You can spend your afternoon chit-chatting, and otherwise, once again, thank you very much to all of you. Appreciate it, and have a wonderful rest of the afternoon. Thank you.